Welcome back to The Explainer, everyone. I am so pumped you're joining me today because we are doing something incredibly rigorous. We're putting Royal Caribbean Cruises, ticker symbol RCL, through what I like to call the investor's gauntlet. We are going to take this high-leverage, post-pandemic turnaround stock and put it through the ultimate stress test. As an investment analyst, I absolutely love doing this. We're going to strip away all the market noise, look at the raw data, and apply the timeless frameworks of investing legends right alongside some hard, modern quantitative models. Let's see if this stock really holds water.
And man, what a story it is right now. Just look at this recent quote from Royal Caribbean CEO Jason Liberty. He pointed out that 2023 was just exceptional, driven by totally unprecedented demand, which is bleeding into a record-breaking start for 2026. Think about it. After surviving a period of practically zero revenue during the pandemic, this cruise line has come roaring back. But as we know, a great comeback story doesn't automatically make it a great stock to buy, right? We really need to look under the hood.
So, here's our game plan for today. We'll start with a quick snapshot of Royal Caribbean, then we'll view the stock through the legendary lenses of Benjamin Graham, Warren Buffett, and Peter Lynch. After that, we'll run a discounted cash flow model, and then wrap it all up with our final verdict.
All right, Section 1. Let's get a clear snapshot of exactly where Royal Caribbean stands today.
For today's analysis, we're anchoring all our data to the Henry Fund Research Report, which evaluates RCL at a current price of $127.97. And Royal Caribbean is an absolute titan in this space. They're a global leader operating 69 ships across major brands like Royal Caribbean, Celebrity Cruises, and Silversea. And they are packing these ships to the brim. In early 2026, they reported an astonishing 109% load factor. They're out there delivering vacations to millions of guests and seriously expanding their market footprint.
Now, breaking down the revenue, about 69% is projected to come from passenger tickets. But you know what? That remaining 31% from onboard and other revenues is absolutely crucial. Management is aggressively targeting what they call their trifecta goals, basically driving up onboard spending. Things like specialty dining, entertainment, and local excursions at their private destinations is the golden ticket to expanding their margins and paying down their massive pandemic-era debt.
Okay, moving to Section 2. It's time to put on the defensive, value investing glasses of the legendary Benjamin Graham. Let's treat Graham's strict defensive investor checklist like a scorecard. Adequate size? Pass. They generate tens of billions in revenue. No problem there. Moderate PE? Pass again. At a forward PE of 12.7, it's actually quite reasonable. But, cue the red ink, financial condition, fail. They are sitting on a staggering $22 billion in debt with a net debt to EBITDA ratio of 5.57x. Earning stability? Fail, obviously, due to those massive pandemic losses. Dividend record? Fail. Dividends were completely halted and they are only just now starting to even discuss them again. So for a strict Graham defensive investor, this scorecard is a giant flashing stop sign.
But let's take it one step further with Graham's intrinsic value formula. This is literally the ultimate mathematical test for finding a margin of safety. The formula is the square root of 22.5 multiplied by earnings per share multiplied by book value per share.
And the result is zero. Yep, zero margin of safety. Why? Well, you have to understand the explicit assumption we're making here. The pandemic essentially vaporized the company's historical equity. To survive, they had to take on massive debt, which led to a negative book value per share. And if you remember your middle school math, when you plug a negative number into a square root formula, the whole thing breaks. In practical terms, it means Benjamin Graham wouldn't even look at this stock until that debt is paid down enough to actually restore positive tangible equity.
Section 3. We're swapping Graham's glasses for the quality-obsessed lens of Warren Buffett.
So how does this cruise titan stack up against Buffett's dream business? On the plus side, the economic moat is fantastic. The cruise industry is practically an oligopoly. Together, Carnival and Royal Caribbean control 62% of the entire market. Plus, RCL's projected continuing value return on equity is sitting at a stellar 19.28%. Buffett absolutely loves an oligopoly with high returns on capital. But, reality check, that 5.57x debt-to-EBITDA ratio and the historically wild earnings volatility, yeah, that would give the Oracle of Omaha some serious heartburn. That being said, Buffett might really respect what management is pulling off right now. They're aggressively expanding highly profitable private destinations like Perfect Day at Coco Cay, and they are consistently hitting their financial targets. For Buffett, owner earnings are everything, and our sources are projecting a 2024 free cash flow of roughly $2.28 billion. That is a massive cash engine. So while Buffett might love the underlying business economics and that cash flow, the heavy debt burden means he definitely demand a massive discount to current prices before taking a bite.
All right, on to Section 4, the Peter Lynch lens, where we are hunting for growth at a reasonable price.
First up, where exactly would Lynch categorize Royal Caribbean? It's kind of a fascinating hybrid, really. It's a classic turnaround play, obviously recovering from the existential threat of COVID-19. It's also deeply cyclical, heavily reliant on everyday folks having extra discretionary income to spend on vacations. But right now, it is behaving exactly like a fast grower.
And this is exactly why Lynch would be absolutely pounding the table right now, a PEG ratio of 0.24. Remember, Peter Lynch loves to evaluate a company by dividing the PE ratio by the earnings growth rate. RCL's forward PE is roughly 12.7. Their projected 2024 earnings per share is $10.09, which is up from $6.63 in 2023. That is an explosive 52.2% growth rate, so 12.7 divided by 52.2 gives you a PEG of 0.24. In Lynch's world, anything under 1.0 is considered cheap. 0.24 is just screamingly undervalued for that level of growth. While our sources don't give us the data on insider buying, so we'll just assume a neutral stance there, this pure growth metric makes RCL a strong buy in the Lynch framework.
Section 5. Time to strip away the philosophy and get into the hard, quantitative numbers with some DCF and alternative models.
Let's walk through the discounted cash flow, or DCF model. We're forecasting free cash flow growing from roughly $2.28 billion in 2024 all the way up to $5.23 billion by 2033. And we're applying a 3% continuing value growth rate. We discount all those future cash flows back to today using a weighted average cost of capital, which is essentially the risk-adjusted cost of money, of 10.21%. The bottom line? We landed an implied intrinsic value of $149.01 per share. Compare that to our anchor price of $127.97, and the math suggests the stock is currently undervalued.
Now, as any analyst will tell you, a DCF is super sensitive to the assumptions you feed into it. Because we're making educated guesses about the future, running a sensitivity table is an absolute must. If interest rates rise or the risk profile changes, pushing that WACC from 10.21% up to, say, 11.2%, the fair value drops significantly. Conversely, if they grow faster in that terminal period, the value spikes. This cable is just a great reminder that $149 is a base case estimate, not some guaranteed floor.
Let's cross-reference that with some alternative models. Looking at the relative valuation compared to its peers, Carnival and Norwegian, RCL is trading at a premium on a price-to-sales basis, which really just reflects its superior margin recovery. But if we look at implied relative values, applying an industry-average PE multiple suggests a value of $142.12. Using an EV to EBITDA approach gives us a fair value of $154.90. Notice the convergence happening here? The quantitative models are uniformly pointing upward right into that $140 to $150 range.
Finally, Section 6, the synthesis and our final verdict.
Here is our master fair value summary. And wow, what a spread. We have drastically different valuations depending entirely on your approach. Graham gives us 0 due to the debt and negative equity. The dividend discount model suggests $105.55, though honestly, because their dividends are irregular and just now recovering, this model is a bit less suitable right now. But look at the growth and cash flow models. The DCF at $149, the PE multiple at $142, and EV/EBITDA at $154. They are all showing clear upside from today's $127 price tag.
We have to be objective here and weigh the reality of this investment. The strengths are undeniable. They're riding unprecedented post-COVID demand. They operate within a highly protected oligopoly moat, and their EPS growth is just explosive. But the risks? They are just as real. That $22 billion debt wall is heavy. Rising fuel costs could easily eat into margins, and as management recently noted, geopolitical issues are causing real itinerary disruptions in places like the Middle East.
So, what is the final verdict? Honestly, it depends entirely on your personal investment philosophy. For conservative value investors like Graham, this is a clear hold or sell until positive equity is restored. For a quality-focused Buffett investor, the trigger to buy would be a very meaningful reduction in debt or a much wider discount.
But for a growth-oriented Peter Lynch investor, the soaring cash flows and that incredible PEG ratio make this a prime turnaround strong buy.
Which leaves us with one final question for you to ponder. At our anchor price of $127.97, the DCF base case of $149.01 offers roughly a 16.4% upside. Given the massive debt load and the economic cyclicality of the cruise industry, is that 16.4% a wide enough margin of safety for your portfolio? That is the ultimate test of the investor's gauntlet. Thanks so much for joining me on this explainer, and I'll catch you in the next one.